there are two very different markets, a weak market and a strong market. Each one follows a different psychological pattern. A weak market usually shows the same behavior. The open looks strong, but by the closing bell, the market starts to fade. You can see the same thing over a week. Early in the week, prices often look strong, but as Friday approaches, selling pressure starts to grow. Why does that happen? The answer isn't the chart. It isn't economic data. Human psychology. The market opens higher. New traders see the strength. They think this market is going up, so they buy. But experienced traders think differently. I'm already in profit. Maybe it's time to lock it in. More traders start taking profits. Selling begins to outweigh buying. By the end of the day, the market loses momentum. The same pattern appears every week. Monday and Tuesday usually feel optimistic, but as the weekend gets closer, people begin to think, I survived this week, but next week could be different. That uncertainty creates more profit-taking. That's why Fridays often become weaker. Now look at a strong market. Everything works the opposite way. The morning may look weak, but buyers keep stepping in. The second half of the day becomes stronger. Even if the week starts slowly, it often finishes with strength. Why? Because traders believe this was just a pullback. The real move starts now. In the end, markets are driven less by news, less by economic reports, and far more by human psychology. If you understand that psychology, you already have an advantage. I always say, follow your rules, trust the probabilities, and that's absolutely true for beginners and even intermediate traders. But professionals operate a little differently. After watching the market for thousands of hours, you begin to notice something the numbers can't explain. The statistics say buy, but somehow this time feels different. That's not magic, that's experience. But be careful. If you're new and you say, I just have a bad feeling, that's not intuition, that's emotion. Real intuition comes from years of experience. Your brain has quietly processed thousands of patterns. So in the beginning, follow your system, but also keep records of what your instincts tell you. Compare both results. Do it hundreds, even thousands of times. If your intuition consistently improves your performance, slowly build it into your process. And if you hit a slump, go right back to the basics. Do that often enough, and your intuition becomes more reliable, not on every trade, but over the long run. When you reach that level, trust your experience. But there is one rule that never changes: your stop loss. Never ignore it. If you think it'll come back, I'll just wait a little longer, that's not intuition, that's hope, that's emotion. You're no longer trading the market, you're protecting your ego. So no matter how experienced you become, never break your stop loss rule. Where should intuition be used? Should you skip an entry? Should you hold the winner longer? Or should you take profits now? That's where experience matters. For example, if the market is moving sideways and you're trying to trail your stop for a huge move, that's not good trading. That's simply failing to read the market. Professional doesn't ignore the rules. Professional builds experience on top of solid rules. That's where real consistency comes from.